Alright, everybody, Stocks by the Numbers, welcome back, and I wanted to do another little earnings play here. We're talking about Take-Two Interactive Software, ticker symbol TTWO, listed here on the NASDAQ. This is a software company in the video game sector. This is the company that has Rockstar Games in its umbrella, and they make Grand Theft Auto. Now, honestly, I haven't really been keeping up with a lot of the gaming releases and what titles that this company specifically is bringing to the table. However, I will say that the stock has been significantly rewarded here throughout 2023 on basically a lot of mixed results, and kind of continued, as we see, climbing throughout early 2024 and hitting new highs today of $171.59. But the stock right now basically 170 even, down about a third of a point, 0.2%. And what's kind of throwing me for a loop is not the fact that it's being rewarded this much, but also why it's being rewarded. Because if we look at these numbers, we can see a lot of inconsistencies here in this company. Missing on the EPS top and bottom line, yet somehow it continued to rally after that. Then you can see a big miss on the profitability side, slight beat on the revenue side, and you can see we had the immediate pop like it didn't even matter, and we pull back, and then boom, we rocket even higher into the 150s. Now here we have a big miss here on the top line, and a miss here on the revenue side as well. And you can see that the stock started to drop down into this consolidated range, but it didn't even matter, because then once another beat comes out, boom, the stock jumps up. So if we look back here, we can see, look, we're like 0 for 2. We're 1 for 4, kind of. We're 1 for 6. 3 for 8, right? If we look at it like that, overall, of the two main metrics that this company reports on earnings day, this company technically is 3 for 8 over the course of the last 4 quarters. Yet somehow, in the same time frame, the stock has been rewarded with almost a 100% move, going from sub $100 before the bull drops to new highs today of $171.59, which just leads me to believe that we're just pumping everything up, and no matter what a company is doing, people are just buying blindly. But here, looking at the numbers real quick, we have a market cap, we'll round up, we'll call it about $29 billion. This company, this is a stock, honestly, that I used to pitch, actually, when I was a licensed broker several years ago, all the way back here. Let me bring up the chart for you guys. All the way back here. See this dip? It was this dip right here at about 7 and change, and then like it rebounded up here, I think, maybe to like the 10, 11 mark. And then that's when I actually personally got licensed and began talking about this stock to clientele. And obviously, as you can see, it was a massive winner, and more people should have listened to me. But either way, that's not the road I want to go down here. We knew the growth that this company was bringing in, because all the way back here at this time, the company had a market cap of, I believe it was about just $1 billion. And one of the main points, one of the main positives for the stock was the fact that anytime, at the time anyway, I don't know how much the sales have changed. Honestly, I haven't been keeping track of the video game companies. But at the time, every time they released Grand Theft Auto, it was, you know, their flagship title, and it would bring in roughly $1 billion in sales, right? So that was obviously a massive selling point. The company's bringing in their market cap value off of just one title. Excuse me. So obviously we knew that that was going to be a big winner, right? But now we can see that even though revenue has been increasing at the time, one of the main drivers here of this is the fact that the company actually finally started making some money and was no longer losing money per share. So that's also what helped add to this massive run here up into the 100+ level. But now you can see the company, for some reason, is losing money again. And now we have an EPS of minus $9 a share. So I have no idea what happened to this stock over the last couple of years. But as we see here, 3 out of 4 misses on the EPS side. Last quarter, they came in with a nice beat, which basically leads me to believe that this EPS report is going to be completely unpredictable. But it does look like, in my opinion, we could potentially make the argument that we're kind of in this rising wedge situation here going into these earnings. And of course, more importantly, see, people are pumped about this earnings because, as you see, again, period ending December, right? So what happens in December? It's holiday season, right? So everyone probably assumes that parents went out, grandparents, they bought the kids all the games that they wanted, boom. So technically something like TTWO should come in above these expectations down here at 1.339 billion for the quarter. However, this is going to be what is this, Q3, and if we go back here, same time last year, company reported 1.41 billion. Right? So even with estimates dipping down here to 133 billion, and let's just say they post, 135, 138 billion, and they come in above these expectations on the revenue side, technically on paper, revenue is still down year over year. And we can see here they were holding at about that 145 billion for this quarter, and then you can see the dip all the way down to 1.28, and then as of last quarter 1.3, and now for this quarter simply 1.33. So what we're having a slowdown in the overall growth and business of TTWO, in my opinion, and the fact that all of these margins here, there is no profitability taking place now lately. So that's why even looking at this jump annually, going from 2 billion and change up here above 3.5 billion, and then recently taking the jump up to about 5.33 billion, you can see that it essentially got canceled out because now all of a sudden the company went net income negative for the year of 2022. And obviously, for the last couple, again, they had a decent EPS here last quarter, but the quarter before was a big miss on the EPS side. So it's definitely not set in stone that this company is going to remain net income positive here at these levels. I think, in my opinion, they need to pump this revenue back up and actually bring more business into themselves to try to become net income positive again quarter over quarter. So that's why, even if the revenue beats here, just the fact that the stock has been up so much, but at the same time, you could make the argument that it's potentially starting to hit its peak and start falling back down the mountain. This is why I'm saying, in my opinion, again, earnings plays 100% a gamble, 100% a risk. Please, please, please understand the risks involved if you're going to take an earnings play position here on any company, whether it's TTWO or Coca-Cola. But long story short, in my opinion, right here is the level I'm looking at, about these low 150 levels here, right kind of at the top of this candle, and this tightening area happening here back in July of 23. I think technically, in my opinion, unless the company comes out and posts some phenomenal numbers here with really upbeat forecasts moving forward, in my opinion, the stock should kind of drop down really no matter what, and drop down to that 150 level. Now, again, I am honest enough to admit, putting my pride in my back pocket, that I do not, I do not know everything about everything, right? So if you guys are a little bit more up to date here with Take-Two Interactive, if there were a couple of titles that came out like over the last 3 to 6 months that you think everyone kind of bought for themselves or their children, their grandchildren this holiday season, and you think that's going to help fuel a beat on the revenue side for this quarter, please let us know down in the comments section. Obviously, all input is welcome and appreciated. But again, with what I'm seeing here recently in the company here, $29 billion market cap, and I can appreciate the fact 535 billion, but we may have hit our peak here for the time being, at least. I'm not sure what the company's looking to do in the years moving forward, but 535 billion, right? So if we just add up some of these quarters here right now, we're already at what we'll call it like 2.6 billion. And now here, another 1.3, so now we're at 3.9 billion. And then if they do a similar 1.3 kind of range, now you're at like 5.2, 5.3 billion. And you can see last year they did 5.35 billion. So we may have a situation now where we're starting to see quarter over quarter potential decreases in revenue. And again, I mentioned that this 1.339 billion for Q3 is less than this 1.41 billion that they brought in this time last year. And I just think this is what worries me about these tech stocks, right? Because again, I mentioned that overall, a lot of these reports are more negative than positive, but the stock got rewarded massively. And it's just really starting to grind my gears, because if this company comes out and comes in light on this revenue, but posts a beat on the EPS side, they might just get rewarded for the heck of it. And that's what's been grinding my gears with a lot of these stocks, because there's a lot of companies out here that do not deserve to go higher. And I know people make the argument, well, stocks always go up, they only go up, and our major indices are trading at, approaching all-time highs, so everything's going higher. Like, I can appreciate the fact they get a little bump because markets go green and start raging, but also at the same time, we should be rewarding companies that are actually growing and doing well. Look at this. 5 quarters in a row missing on the EPS side minus last quarter, yet somehow throughout this whole time frame, the stock was climbing higher. Look at the revenue coming in for this stock. Now remember, this is a company that is up like 80% year to date. No, excuse me, over, you know what I'm saying, over the last 12 months throughout 2023 and even going into 2024. This is a company that consistently went higher over the last like 14 straight months. And I would love an explanation why. Because as you see here on this screen, we have a sea of red. And usually, correct me if I'm wrong, but usually red is bad and green is good, right? So if we have predominantly bad, red, negative situations, how can the stock be positive? Just makes no sense. But you can see here now, looking at the forecast here, you can see that for next quarter, they're estimating about 1.51 billion. That's a nice little jump up back to kind of where they were about a year and a half ago. So if that does happen, if they meet or come, in line here with these next 2 quarters, they'll probably do around the same annual revenue that they did for 22 here, a little over 5.25 billion. But I don't know if we can have high conviction in this situation, right? Because like I said, even going back, what is this? This is showing us the last 8 quarters, right? Based on what you're seeing here with the revenue coming in for this company for the last 8 quarters, I mean, if you had to take a position, would you think that they have a higher chance of missing or a higher chance of beating? Because they missed 6 of the last 8 quarters. And on the EPS side, they missed 5 of the last 8 quarters. So the fact that the stock even went from 99, 100 up to 160, 170, wherever it is now, is an absolute embarrassment. We have look at what they did to PayPal. Again. PayPal comes out, beats estimates. They want to worry about profitability potentially dropping into 2024. They're going to run into a roadblock. They're going to have obstacles. The stock, we got to drop it 10-15% back down to $50. We got to have it hit new low. So what's going on with Take-Two? Even if Take-Two back here at this time forecasted that this time would be better, it's really not. It hasn't gotten better. We're not seeing consistent beats. We're not seeing, consistent upticks in business or profitability. They just turned around on the EPS side. But this whole time, they were being rewarded. So, listen, there are a lot of different ways to look at this situation. I mean, we can say, oh, it's a video game company, it's a tech stock, so it's just going to go up no matter what. And I mean, if at the end of the day that's the mentality, then listen, if you're a shareholder or a call buyer, listen, more power to you. You always know I don't wish ill on anybody, and I really hope the bulk of you watching make a couple of dollars and do very well in the market. I really do that. I really do hope for that, whether it's something I agree with or not. But looking at this, for us to say, yeah, we might want to go with puts today instead of calls, you kind of can't call me crazy for coming to that conclusion, right? You kind of can't. And believe me, I'm a gamer. Played a lot of games in my day. So I appreciate the appeal. That's why even like I said, when I got licensed, this was one of the few stocks on the table that I was looking at. And I said, no, this is the one that's going to grow over time. This is the stock you want to own. And again, at that time, I was right. As of late, looking at the situation, I have no clue why this stock is being rewarded. I really do not. But let's look at the forecast here from these analysts. Look at this. Price target as low as $130 a share. See, that may be a little excessive, but again, look at this. Look at this rally here. Again, missing most of the way. So to see a big pullback to 130 might actually be justified. But overall, you can see analysts are pretty pumped about this situation, right? Because we've seen the gaming industry as a whole grow astronomically, especially over the last couple of years. So I can appreciate the fact that people are kind of just saying, yeah, it really doesn't matter, whether they have a couple of rough quarters, you're going to turn around 2, 3, 5 years from now and it's going to be growing, it's going to be just fine. I can appreciate that argument. But again, after this massive rally over the last 12, 13 straight months, as the company was consistently being inconsistent and missing on EPS and revenue estimates, you can't call me crazy for being more on the put side now than on the call side here going into these earnings. But as you see here, we have 21, 26, 7 analysts, 27 analysts in total watching the stock. We have 17 giving it a strong buy, 4 giving it a buy, 5 giving it a hold, 1 guy, much respect to that guy, giving it a sell rating, and I'm assuming that's the guy with the 130 price target. But again, I appreciate the fact, the EPS just recently turned around, but I am seeing really more negatives than positives in my opinion. So in my eyes, it's not completely adding up. You can see the price to sales now back up to 5 1/3. Look, that's the highest it's been going back the last 7 quarters, 8 quarters, right? And remember, this whole time they were missing on the EPS and revenue side for the most part, right? No cash flow. Company now trading 3.4 times book value. That's the highest it's been going all the way back to Q4 of 21 when they were in a much better financial situation, right? Again, they've missed the bulk of the times on the EPS and revenue side during this whole rally here, and now we're up to 3.4 times book. Enterprise value, $31 billion. No way. No way, in my opinion. But even here, look, the return on assets. Look, we went from positive to negative. Return on equity, positive to negative, dipping down quarter over quarter. Return on invested capital, positive to negative, dipping down quarter over quarter. Gross margin percentage almost got cut in half, was north of 50%. Now it's down here at 28%. And look at where it was, almost 56%, almost 59%. Look at that, holding, excuse me, holding that high 30, low 40%, then all of a sudden you fall off the cliff, you have a slight rebound, and then you drop it back down again, 50% from that level. I mean, I'm seeing a hell of a lot more red flags than I'm seeing green flags here. But again, somehow the stock has been rewarded. Look at the operating margin. Was up here at 14%. That's nothing to sneeze at. We've seen a lot of companies struggling with these margin percentages, right? Fighting to get them positive, fighting to get them even above something as low as 4 or 5%, and trying to break into that double-digit 10, 12% mark. And look, the company had an operating margin was almost at 14.5%, and then went negative and has not recovered. 2 quarters ago, minus 14.5%. The following quarter, almost minus 29%. So your operating margin percentage loss doubled quarter over quarter, yet the stock hit a new high today. What the hell's going on? EBITDA, once again, earnings before interest, taxes, depreciation, amortization. We can see, look at this, mid to high teens, up here in the 20s, then all of a sudden sub 14%, 11.2%. That is bad. That is not good. The net margin percentage we looked at before as well, look at this, was up here at 12%, then completely falls off the cliff, losses double quarter over quarter, you have a nice rebound there of about 40%, and then you quadruple down to minus 42%. You have a nice attempt at a rebound there up to minus 16%, and then boom, right back off the cliff, back down there at around minus 42%. So I'm not sure how other people are looking at the situation, but in my eyes, I personally would not be a buyer of TTW stock here. And in the immediate short term, in my opinion, again, earnings play is very risky, but in my opinion, I would be buying puts on TTWO, not calls. And look at the asset turnover as well. I mean, we're talking, like a 40% drop here, going from 0.56 down into the 3s. Rebounding, trying to get back to that 0.5 level, and then dropping down to that 0.33 consistently here, it looks like. So I am not impressed, we'll say. I am not impressed with what I'm seeing here. Again, this growth here, very nice. Very nice revenue growth there year over year. But overall, as of late, I am not seeing a lot of positives here. Look at the debt explosion there for 22, jumping up to about 3.5 billion. And the last couple of quarters, let's see, 3.6, 3.5, 3.5, 3.5, back 3.5. Okay, so the debt jumped up to about 3.5 billion, and it's been maintaining on their balance sheet for the last several quarters here. And I just want to look at the cash, 1.55 cash and equivalents. I'm looking at the dark blue bar here, 1.119, 114, 116, 118. I mean, technically you can say it ticked a little higher in the last couple of years, but the last couple of quarters, but I don't know. Again, in my opinion, I think we do go down before we go up. We have short-term liabilities now outweighing short-term assets, meaning we could run into some short-term volatility and sell-offs before going to more long-term growth here. Long-term assets, very nice over liabilities. Quickly. But yeah, I don't like this recent drop. And you can see cost of goods bumped up here, up to about 930 million. And total revenue minus cost of goods sold, yields gross profit, you can see was up here 600 million, drops to 150, regains to 650, and then drops back down to 360. So that's what I mean. We're seeing inconsistencies here, and just because it's a holiday season earnings report, I'm not exactly convinced that the company should be rewarded today. Of course, it depends on what numbers they post. For all we know, they can blow these estimates out of the water. Then I can understand making the argument to bring it higher. But again, we looked at a lot of fundamentals here, and I personally am seeing more red flags than I am seeing green flags. And you can see also, look at the book value per share here. Assets have been dipping down, right? And they're trying to get their liabilities in line, but we can see assets minus liabilities yields total equity. And we can see the equity was up to about 9 2/3 billion. Now it's down to less than 8.5 billion, right? And I told you that affects the book value per share. And you can see, going back not even too long ago, the book value per share was up here at slightly above $58 a share. And basically, overall, minus that small bump, have been decreasing quarter over quarter like clockwork. Now it's sub 50. So the actual book value per share, the real true worth of this stock, is down by like 17-20%. But yet, in the last 12-13 months, the stock is up 80%. Make it make sense. Make it make sense. That's what I'm saying. But moving forward here, let's just look at the forecast. We can see, again, look, they're expecting a slight bump here for 2023 revenue, and then just looking to explode here moving forward into 24, 25, getting above 8 billion, and even 26, 8.22 billion. However, again, looking at the history of the stock, it's almost 50-50. So, they can forecast all they want, but it doesn't seem like they have a very high chance to actually meet those expectations. Looking annually, the company has been doing very well on the EPS side. I will say that. However, look at the dip they're expecting here in EPS for 2023. So that's what I'm saying. There's a lot. Again, to bring up something like PayPal, they just took PayPal to the shed because they're forecasting that profitability went lower. Well, here, Take-Two's saying they're expecting profitability to drop down for 2023. And as of late, again, they've been missing for the most part on the EPS side and missing for the most part on the revenue side. So with all of these negatives lining up back to back, how is the stock being rewarded? That's what I want to understand here. Seeing some slight dips, seeing some slight pops. Of course, the United States generating most of its revenue because they're basically just, in my opinion, just price gouging Americans here. Who knows? Microtransactions. Who knows what the hell's going on here? I mean, growing internationally as well. Again, that's what's great about the gaming market, right? You put it out globally. It could appeal to everybody around the world. Anyone who's interested, you can generate some revenue from. So that's why looking at the inconsistencies, to me, again, in my opinion, is really just not adding up, not making sense. But now we have T-minus about 30 minutes to go, so I don't even know how many people are going to see this video, but as of late, again, we had the pop-up here. Everyone's pumped for these earnings. Stock was up again, hitting new highs today, north of 171 here, 171.59. We got the MACD crossing a little bit to the upside, adding to that situation, but in my opinion, it really should reject here and start dropping back down here to this moving average, and it should break, and even pulling back here to this 200-day here, the mid to high 140s, the low 150s, in my opinion. That is where the stock should be. Switch over here to weekly real quick. You can see, look at the RSI now sitting here above 71, right? Which technically means the stock is overbought. The last time we had the pump above 70, the stock went into a sell-off, but we have earnings coming out, so we don't know what's going to happen. But look at this perfect pullback here. Mid-Bollinger Band, the touch below 154, 200-day moving average on the weekly, 149.58. That, in my opinion, again, is where the stock should be, right around that 150 level, potentially even a couple of dollars lower. But, we'll see what happens. Again, we know earnings plays are basically 100% a gamble. You never know what the company's going to say. You never know what the numbers really are. But up here, I mean, again, even if the company misses, they might bring the stock up. So you may see the next resistance up here at 183, even though, again, in my opinion, it doesn't deserve it. But that doesn't always mean that it's definitely going to happen. But you can see here, as of late, they brought it up here, dropped it down, and it bounced nicely off of this pivot point of about 163.72 and jumped up here next to the next resistance level here, 170.77. And the stock, you can see, again, got up to about 171.5 and then rejected and pulled back here. So that's why if this is where it was bouncing off of recently and then the company comes out with bad news, it should have no problem breaking that level and going even lower, which is why 161.30 on this moving average and even this support here, 157.87. I'm just seeing, in my opinion, I'm seeing that we probably have a stronger move down to the 160s and the 150s as opposed to a higher pop up into the 180s. That's basically what I'm saying here. But RSI basically staying middle of the road here right now, sitting at 62. But yeah, just wanted to give a quick look here at Take-Two Interactive Software, TTWO, here on the NASDAQ. This is a company that has done very, very well over the years, but may potentially run into a couple of speed bumps and a couple of obstacles here in the next 1-2 earnings reports, earnings coming out T-minus 30 minutes after the close. And if anyone's getting involved, I wish you the very best. And I'm going to end it there. So once again, this is Stocks by the Numbers. I want to thank you guys for stopping by. If you have any questions, comments, or concerns, drop it down in the comments section. I'm usually very quick to reply. Thumbs up algorithm helps me get more eyes on the channel. And of course, subscribe to the channel. That is our handshake agreement. That is how you help me help you. But of course, more importantly, moving forward, like I always say, I understand that markets are rocky and volatile and very uncertain. So I want to wish all of you success. I hope everyone makes a couple of dollars. Thanks for stopping by. I'll see you in the next one.